Everyone. Our next presentation is on data and technology by IAG member Ms. Gina Sanchez. Gina is CEO of Chantico Global, a global consulting firm with offices in Los Angeles and London that advises global pension, foundation, and family office clients. She also serves as a trustee of the Los Angeles County Employee Retirement Association, as well as a member of the board of directors for Cedars-Sinai Hospital. The presentation will cover aspects of data and technology that can be leveraged to enhance audit quality and investor protection. Gina, the floor is yours.
Thank you, Amy, and thank you, Saba, for the opportunity. This was certainly a deep dive learning experience. It was like throwing me in at the deep end. So I will go ahead and launch into the presentation. If you could go ahead and advance the slide. And yes, the views expressed are solely my own. Thank you. Great. So this is just a quick agenda. We'll just discuss, why digitize, what is the current state of information flow, PCAOB information and potential uses, lessons from Edgar, and some technology options and, some key takeaways. I anticipate there will be lots of questions. Feel free to raise your hand at any point in the presentation. There are only 10 slides, so I don't have that much to go through. But I will say that the one thing that I want to begin with is that there is already a lot of information that is currently being captured by the PCAOB that without question would enhance the ultimate goal. So let's talk about what the ultimate goal is and what the current kind of flow of information is. The ultimate goal really is greater investor protection. As investors, we have to live with the outcomes and the potential that the information that we are looking at may or not be either high quality or fraudulent. And so the greater the number of eyes on this effort, the better. The SEC obviously began that process by taking financial statement preparation and making it more digital through Edgar. The goal really was that if we can create more financial reporting using structured data, that in and of itself would enhance and create a more effective audit. In fact, I won't discuss the potential impacts of data and technology on the audit itself, although that is a whole nother area of exploration. But this certainly will help for continuous auditing processes, et cetera. But that could also in turn lead us to more timely information that would result in more effective consumption of information. Hopefully that consumption of information will cause study, research, papers, and transparency that could help with greater effective regulation, because we know that regulatory bodies do not have the number of people required in order to stay on top of these issues. And so incentivizing your investors and companies to stay on top of this data greatly enhances your ability to provide for effective regulation. Effective regulation leads to greater market risk and price discovery. We've discussed that already, and ultimately that protects the investor. Now, moving on to why, where the PCAOB fits into all of this. On the next slide, you see that there is a lot of information already available. What we want to provide is beyond that timely information. We also want to start to link in corporate audit, the corporate audit information in the form of Form AP information, enforcement actions, inspection reports, and remediation failure reports, along with other things that we've discussed. These were just sort of the elements that I saw were low-hanging fruit, just sitting on the website in PDF form or in other sort of searchable form, but not really easily downloadable or aggregatable form. And so I was really looking for low-hanging fruit that could improve this process. Moving on, we can discuss kind of how information currently flows. The source of most of the information that we're getting is either from tax. That tax preparation should also include statement preparation, what the CFO does. And so really you start with that statement preparation. Right now, it tends to get outsourced to some kind of XBRL or IXBRL preparation, which does all of the tagging after the fact. So you first prepare your statements and then you do the tagging after the fact. Then you have the auditor information that's the very meager auditor information that's part of the current disclosures right now. We know who the audit firm is, we know what the opinion is, so we don't have much beyond that, to Sandy's point earlier. Now, the users of this data are largely the data aggregation platforms such as Bloomberg, FactSet, Reuters. This is where a lot of investors get the information that they get. Ratings agencies certainly make an effort to use this information in order to provide better credit ratings. And of course, the auditors themselves do try to use this information, but then can continue to use this information. Those are your sort of intermediate users. At the investor level, you have direct investors, fund managers, or individual investors. You have creditors, and you have, the fund investors, which are end investors, institutional investors such as pensions, foundations, endowments, RIAs, et cetera. So there's a lot of users of this data. They're intermediate users of this data. But the problem is that we still have not yet achieved sort of that goal of that greater efficiency we were going for. So on the next slide, I can kind of talk a little bit about what the information is that we want to try to use to help kind of achieve that nirvana. And we'll discuss some lessons as to why we haven't achieved the nirvana. The main areas that I kind of found very, very quickly through my own kind of diving into the website is you have firm registration is one area where you can get a lot of information firm by firm, but to Sandy's point, it can be very hard to know which item to click on. There is a lot of information there, though. You can look at who is registered. Conversely, you can go and find out who's not registered. You can see all of the Form APs for all of the issuer audits. You can look at disciplinary proceedings, inspection reports. That is all available, and it is linked at the firm level, but sort of, once you start to try to aggregate data, link it together and ask kind of meaningful questions about what this could mean, it does become hard to use. The firm inspections are available through an inspections report search. It's also, like I said, they're available at the firm registration level as well. But, there's also a separate remediation failures segment along with the firm response, which is also potentially very useful information to have available, connected to the search, connected to the firm, connected to the engagement partner. The Form AP has a tremendous amount of data within the Form AP that is currently available through an auditor search. And so I can tell, it's very clear that somebody made an effort to try to make the auditor search something that you could use, but from the perspective of downloading data and being able to aggregate it into a study, that's kind of the bigger question. Enforcement actions, of course, you want to keep track of that information. And before I move on from this slide, I kind of want to talk a little bit about sort of what all of this data can be used for, and in fact, what it already is being used for. I pulled a sample literature review as I was just kind of going through and understanding why this data is important and why it is important to take the information and put it into a more usable form. And one of the observations that I quickly made was that many of the sample sizes of the studies that I read were very small. And I suspect that the reason that the sample size was very small is because it is very difficult to pull this information. But I'll give you sort of some titles of some of these reports. The first report came from the ICFAI Journal of Audit Practice, and that is Audit Tenure, Managerial Fraud, and Report Qualification, a game theoretic approach that basically looks at auditor tenure and its relationship to managerial fraud and the result of whether or not you get a qualified opinion out of that. Now, that's a game theory approach, and I think one of the reasons you take the game theory approach is sometimes because you don't have all the data that you need, but it is one of my favorite papers because it does actually kind of look at auditor tenure as an optimality and not as a linear relationship to the potential for fraud and audit quality. There's another piece on the economics of audit partner tenure and rotation evidence from the PCAOB data. That was a Stanford paper. The relationship between auditor tenure and audit quality implied by going concern opinions. Audit practices, audit pricing and independence, audit strategies and multiple fraud opportunities for misreporting. the interaction between audit quality and managerial reporting choices, and its effect on financial reporting quality. All of these, and there are many, many more. I mean, there's actually quite a few studies in the literature review that show you that, in fact, there's quite a bit of effort at taking this data that is available at the PCAOB, but not yet sort of formalized into a database. And so I'll move on now to kind of these lessons from Edgar. The reason I look at Edgar is you know, to some a wonderful innovation, and to others very difficult to use. I think one of the challenges is that when Edgar kind of became more digitized, it was happening at a time when even the state of technology was still evolving. So, you know, it wasn't until 2005 that the SEC established that voluntary XBRL filing process, right? Which was a way of moving, you know, Edgar first sort of took paper filings that used to come to the SEC and put them into PDF form, right? XBRL was a way of tagging those PDF documents so that rather than being a whole bunch of unstructured data that you would have to use imperfect natural language processing methods to try to pull data out, in fact, you could just simply tag it and you could find, you know, what gross revenue was in each of the documents, for example. Now, the problem was that at the beginning, it was voluntary. And of course, the taxonomy of what the tags were, that was evolving. Eventually, it became standardized. And even so, we still have further opportunities to continue to standardize that. But what I want to sort of emphasize is that just because Edgar is the only digitized version of financial data and it used XBRL doesn't mean that that is your only option. In fact, XBRL was really a way, and inline XBRL, which was sort of the innovation around XBRL, which was both machine readable and human readable. That is the current, you know, sort of standard of practice. But it is still a way of dealing with very non-standard information. The other problem is that because this data tagging doesn't generally occur as a matter of process at the time of statement preparation, which is sort of like, you know, data tagging at the source, it tended to be done after the fact. The data tagging itself is never really audited. So anybody who's ever had to use the information coming out of FactSet or out of Bloomberg knows that you can have just problems with the data. It is slightly error prone. Automation is challenging because every statement is prepared differently. So the process of automation happens, you know, at the firm level. It's not sort of some broad automation process that can occur across, you know, anybody. I think that the kind of goal of trying to figure out where in the process you're going to enforce this tagging process and whether or not you create a method for some kind of audit before it gets out to be used, I think that's really important. In many ways, XBRL got a bad name because it was pushed out there and some of the data just wasn't that useful. You know, the other thing that I would say is that, you know, Edgar did make a huge effort to sort of go from that XBRL data and link it to an API that is then downloadable. Now, because of that, it did mean that the majority of the users were going to be intermediate aggregators that have the capacity to be able to take that API data, turn it into a database and make it searchable, usable, and somewhat standardized for investors to be able to do. But what it does is it creates sort of an economic gap between which investors have the ability to access that data and which do not. Even though it's public information, because it's sort of not so easy to use, you still end up having to pay somebody to aggregate that information for you. And so, you know, I think that the lessons that we have to think about, and we sort of talked about them, you know, Hal has certainly brought these up, is that the process of how we enforce, now some of this XBRL or however we choose to do that may be happening at the PCAOB, but it also may be happening at the audit firm. And you have to think about what that process is going to look like, because if the tagging happens after the fact, no one will look at it. That's the challenge that you have. If there's no incentive to audit that XBRL tagging, that's a challenge. The second is that the standardization of the tagging taxonomy is also very, very important. The more you can standardize, the better. And so these are sort of the things that you learn. Going on to the next slide, I would say that there are times when you want to use XBRL or IXBRL, and there are times when you don't, right? It was really created at a time, like I said, when we were evolving from sort of machine to PDF format, to sort of trying to figure out how to get it into some structured form and then eventually into a database. But not every form is necessarily unique. In fact, the more standardized your forms are, the more likely you are to be able to create a direct portal into a database rather than go through this XBRL, which is really just a way, it's a very imperfect method. I see a question from Lynn already. Go ahead, Lynn.
Yeah, Gina, I've got a question for you on this slide. XBRL is not within the authority of the PCAOB.
Mm-hmm.
It would require the SEC to take steps with respect to the controls and processes companies and their publishers use when tagging and submitting the data to the SEC. The PCAOB really could only act if the SEC said we're going to have this information audited by whomever. That the PCAOB could step in and would have something to do at that point in time. So I'm curious, and before the SEC and PCAOB could do that, they would have to go through a cost benefit study. And Gensler has got a full agenda that he's probably going to have difficulty with for the next couple of years anyway. So
Yeah.
I'm curious, when you're talking about XBRL in that context, what is there here that you're going to ask the PCAOB to do? Because I don't see anything that is here for them to do, at least in the next few years.
So this is not actually intending for the PCAOB to interact with the SEC on financial data. That is purely the realm of the SEC. This is a lesson from Edgar, really, so that the PCAOB can think about how to take whatever forms. There are lots of PDF forms right now that are currently available on the website that are submitted by the auditors. And the idea is what the PCAOB has to decide is, if you're going to take, for example, the Form AP, which is one of the richest forms of information that we collect at the engagement level, is do we take, or the registration form for that matter, do we use XBRL and sort of create a process that requires the auditors to not only submit those forms, but also require them to data tag, to XBRL tag through a taxonomy, those forms, such that the PCAOB can begin to compile information that can be linked to the financial information to enhance transparency at the investor level. So I'm not kind of suggesting that it's the PCAOB working with SEC on financial data. It's really the PCAOB figuring out how to take the mountains of PDFs that we have on our website and turn them into something that is more usable and aggregatable to the investors, to researchers, in order to sort of help answer these questions as to whether or not there is a relationship between audit tenure and the potential for fraud, between the auditor and the number of engagements that they have, auditor and the potential for a qualified opinion, and the audit specific experience that they might have in terms of industry experience, and the potential for audit quality. And so that's information that we have. It's locked in PDFs, And so the question is, how do you unlock that information from a technological perspective? There are kind of two roads that I see ahead. Either you take the XBRL route, which is to just say to the audit firms, okay, you still have to submit all of this information, but the PCAOB is now going to require you to data tag them, right? Or the PCAOB evolves to create a portal where you actually submit information electronically through forms where the information is very formulaic, and then that information feeds directly to a database, right? Those are the two paths that I see, but that's kind of, does that answer your question?
Would it be, what role do you think would be there for an intermediary like a FactSet or Capital IQ who would lock in to those data feeds and then make it distributable globally to the portfolio managers and analysts who are probably already using that service?
Yeah, and that's one of the probably initial kind of low hanging fruit wins that you can get, which is that if you Edgarize this, to use that term, which is that if you take information that's currently unstructured, you create not only a database for it, but then you build an API service into that database. The aggregators already know how to do that. It's quite easy. I'm oversimplifying it, but it is very doable. I mean, we just built a feed directly into Fred, for example, using their API. It took us 2 days of work from a technology standpoint. So the point that I'm making is that as soon as you can make the leap from unstructured data to structured data, either through tagging or through a database input, and then create an API or some easy way for aggregators to be able to extract that data, you will already get some wins off of that effort.
Thanks, Gina.
Thank you, Lynn, for the question. I see a couple of hands up. I see Jonathan. No, Hal first, Jonathan, then Board Member Thompson, and then Alicia. So,
Absolutely.
Hal, you're next.
Yeah, I think Lynn has touched on a very important issue, foundational issue to this group. If we see a problem, we see an opportunity to help investors, if the PCAOB is not directly responsible, but could have an influential role, is that something that we should be discussing? I personally think it is, because I think that if we can help the PCAOB see how roadblocks can be removed, and Gina has done a great job of articulating some of those roadblocks, then we could really provide a lot of value added. In this particular case, maybe the PCAOB could work with the SEC and say, here are 3 things that could be done. We could improve tagging of some of the audit quality indicators. We could encourage the SEC to require tagging of earnings releases, which would then enhance the value of these audit quality indicators, because more information is consumed out of the earnings releases than it is out of the Qs and Ks. Qs and Ks are great, but late, okay? So if we can look at the financial reporting supply chain and help the PCAOB see how there can be improvements to that process, if it requires interaction with the SEC, is that something that we want to pursue? I personally think it is, and we should pursue that. But I wanted to lay that on the table, and if we take that approach, I think we can easily address issues like cost benefit, because tagging of an earnings release has virtually no additional cost, since it's just pulling information forward from that's already going to be in a Q or a K, and already tagged. So you could have very low cost and tremendous positive impact. And the PCAOB's role would be through the normal auditing of whatever information is coming out. And so anyway, I just leave it there. I think it's a foundational issue we should discuss, but I would encourage us to push the PCAOB, to push the SEC to explore some of these opportunities.
Thank you, Hal. So unless Gina, you have a comment, Board Member Thompson is next.
Great. Well, I think while Board Member Thompson gets his question ready, if we could just advance to the next slide just so that you can see it, because otherwise we'll never get to it. Go ahead, Board Member Thompson.
Yes, Jenny, you may want to discuss or have an answer for this later in your discussion, but it seems to me that the issue with, PDF files being attached but being interpreted as data in terms of aggregation is kind of a universal problem. And, we've seen many systems that say, well, I have, data ingest, but they really don't, because it's really, attachment of PDF files. And it's the conundrum that, I ran into at, CFTC with data aggregation, with a lot of industry data, and then being able to break that, down to where, one, it's multiple data sets coming in, interpreting it in the right context, and combining data sets, with this, challenge of PDF files. And so, again, I just wondered, is there any examples out there where someone else in industry has kind of, made this leap of faith and solved this issue?
Well, thank you for that comment and that question. I think that the way that the industry has been solving or sort of getting over this issue also sort of is happening in line with the evolution of the ability to sort of create easier data portals, form portals that sort of link directly to a database. If you look at the evolution of how we went from paper to PDF to XBRL to API, this process didn't really become mandatory until 2009. And at that point, it was still very, very difficult to host, to easily and efficiently and inexpensively host a cloud-based database. That in the last 5 years has actually changed dramatically. Because of that, it's one of the reasons that you see so many web apps and even just web app tools in order to sort of allow for the creation, the inexpensive creation of a form for very, very standardized information that would then just go directly without sort of that in between step that is, quite frankly, error prone and very, very affected by process. Meaning moving from, we send you a PDF form, you fill it out, we send it back. I mean, you could get fancy and send a pre-tagged PDF form, but if it can be pre-tagged, it can be created into a data portal that becomes an online registration process where you are entering your information and it literally whisks right into a database that has less chances for error in the process. And so that's one of the reasons that I say that the time right now, the PCAOB may have the benefit of leapfrogging the learning process that the SEC had to go through by virtue of where technology was at that time. And that's one of the reasons that I say that when the PCAOB sits down to really put a working group together, one of the questions you have to ask is what is truly standardized and what really needs to be individualized and data tagged, where the information is very textual and has to be it has to be put into some sort of context. And so I'm just trying to sort of bring home the point that the cost of creating web portals has dropped dramatically. We have 3 more questions. I only have a key takeaway slide, so you can actually move on to the key takeaway slide. And Alicia, you want to go ahead?
Thank you. Thank you for the presentation, Gina. What a nice synopsis of sort of where we are and where we've come from. When I was thinking about this issue ahead of this meeting, while I understand that we are naturally looking towards the SEC and that for a number of reasons that makes a lot of sense, there are other agencies or entities, pardon me, within sort of the federal structure who have similar issues. And the one, just given my focus area around the financial services sector, the Federal Reserve comes to mind, right? And they are dealing with reams of data that is typically being submitted by 5,000 plus financial institutions on a monthly basis, which then the Philadelphia Fed, for example, compiles into a quarterly state of the US banking sector, et cetera. So it occurred to me that while we can sort of take the historical PDF repository and convert that into very valuable historical trend data and just historical data on specific firms, looking forward, perhaps the PCAOB might want to look at this issue through a slightly different lens, which not just enables investors to be looking at this, to be able to access this information in a more efficient, better format, but also for the PCAOB to be able to be providing perhaps even more value-add analysis than they provide currently on their scheduled service. So I just wanted to mention that.
If I could jump in just real quick on that, Alicia, I think you've hit on the standardization issue, and the forms and data that are being collected we're talking about, I think are all highly standardized. And that's something that the SEC had made a decision back 2005, 6, somewhere. Oh, sorry, to have a far more flexible format. So I think that's one of the things that we'd have to sit and explore a little bit more, standardization as opposed to a more flexible format, which is what XBRL is today.
Thank you, Hal. So I see Board Member Ho's hand and Sandy Peters. So Board Member Ho, you're next.
Yeah, thank you for the presentation and all the comments. I actually am very familiar with some of these lessons learned. And the Federal Reserve, those call report are XBRL as well, but it's a closed taxonomy, not like the SEC one, which is an open taxonomy that has all kinds of extension, which kind of defeat the purpose of standardization. Another example I personally have experienced is structuring all of the federal agencies' financial data and spending data and publishing it on a website. So I think there's a whole cycle: collection, standardization, and publication. Now, I guess what I'm trying to, right now, I think for in terms of demonstrating progress, because the earlier you start that involve collection and all that, the more people and entities that are involved, the more challenging it will be. But what I want to ask is, because right now our audit search database is actually already digitized. It's in CSV format. It's not API. Certainly that can be done, but it's already in CSV format, and it can be downloaded daily. And there is a data dictionary there. It's not as good as trying to tag it at the source so that we have one source of truth, but what you're suggesting, are you thinking of additional data than what's in the auditor search?
Yeah, I think when I went out to speak to users of this data, there was one common refrain and request was that they wanted more digital access to the information contained in the Form APs. And so while, yes, I agree that there's definitely I definitely already some digitization that has occurred. That auditor search very clearly demonstrates that there was an effort to begin that process, but that Form AP information is quite valuable and still not as accessible as it could be. And so that's I think if you were looking for the first low-hanging fruit, that was probably the one that I heard from every single investor, anybody who was working, at the various ratings agencies that were putting together audit quality scores and things like that. That was the thing that they really wanted the most. And so that if you put them in order, I would say that is there's so much information contained there that could be valuable.
Okay, thank you.
You're welcome.
Thank you. So I see Sandy Peters hand up too. Sandy, it's your turn.
Sure. Gina, thank you for the nice, very understandable summary of this. I have to say that the conversation today, even the previous stuff and this, has been sort of rewarding for me as someone who has fought the battle about nobody uses XBRL for the last 15 years.
Okay, we can go out on a drink on that one.
Exactly. It's like all of a sudden everyone is using XBRL, right? And so just by way of background, we have advocated that stuff be not tagged at the end, but at the beginning. So we would actually like tag data in the ledger, right? Is what we've said. And we've actually, in every comment letter we've issued to the SEC, we talk about tagging of the data. And most recently with the Council of Institutional Investors, we've told the SEC that any correspondence they have with issuers over comments, we'd like tagged so that we can search it. Right, so that investors can search it, right? And we actually think that that might be good when in submitting comment letters as well, right? So that investors can more easily download comment letters. I think it's also applicable here in the context of the PCAOB, from the sense of all of the reports that are issued, all of the inspection reports and the like, would be interesting to be if they were tagged and could be analyzed. I think also in the comment letters that are submitted to the PCAOB, I mean, that would not be the PCAOB's responsibility. It could, but it would have to be the person submitting it generally. That would be the better way to tag it. So I guess I've heard so much recently about people saying we need to break through PDFs. It's like, oh my God, everybody's woke up. You know what I mean? Because we've been saying this for years and nobody's like, oh, nobody uses XBRL. And you're like, yes, they do. You just don't know it. It's like saying, do you use HTML? And everybody uses HTML. So I'm in raging agreement with what you've said. And I think that as it relates to what we've actually said, the FASB needs to consider this as well, that they manage the gap taxonomy in just how they actually do their standard setting more precisely, because we believe it needs to start from the very beginning, not the end. We've gone from paper to PDF or to tagging, but still with a paper mindset. So I'm all in on what you're saying, and I think you did a really nice job summarizing it.
Thank you, Sandy. And I think to Director Ho's comment, I think it's important to remember that the more you can create tagging extensions, the more you run into problems. And I think that notion of a closed taxonomy is one that should definitely be considered where possible, because it does reduce the problem.
Yeah, I didn't actually say that, but we have actually advocated for there to be attestation over the tagging. If you look back at our comment letters, I'm sure the PCAOB has some history of us saying that back in the day. So, and maybe our comment letters on the strategic plan, the last one and the one before, maybe. So.
Great. Well, we have 6 minutes to spare, and I think we've exhausted the comments that I prepared and the questions, unless there are any last burning questions.
Thank you, Gina. We don't see any hands. Thank you, Gina, for this very helpful presentation. It was a lively discussion. I hope everyone enjoyed it. So it was slightly ahead of the schedule, which is great. We'll move on to the next topic on the agenda, which is dear and near to my heart, as well as Chair Williams. It's diversity and talent and diversity issues in the audit profession. It will be presented by Professor Jennifer Joe. Professor Jennifer Joe is the Whitney Family Professor of Accounting and Cohen Family Lerner Director of Diversity at the University of Delaware. She's an award-winning researcher whose work examines how key institutional factors impact the quality of corporate financial reporting, including audit litigation, regulations, audit quality, and data analytics tools, and the role of cognition in decisions using accounting information. So I will now hand it over to Professor Joe.
Thank you, Saba, and to the board for listening to my comments. As all of us here have noted, the views that I'm going to express today are solely my own, and not necessarily those of the PCAOB, members of the board, the PCAOB staff. And the PCAOB makes no representation as to the accuracy and completeness of this information. Could you advance the next slide, please? So I wanted to talk to you about, I think, an issue that many of us are aware of and is a matter of great concern to us, and that is the talent deficit that is facing the accounting profession. If one looks at the trend reports, which is the document that the AICPA releases every year and sort of has like a look back at the proportions and incidences of people in the profession, and also takes a forward-looking, asking directors of schools of accountancy to report on upcoming enrollment. And if we look at the data in those reports, we see that the number of people who are sitting for CPA exams are declining. And CPA exams should be of concern to us who are investors using financial statements, because the people who are responsible for financial statements, they first have to be CPAs. So the partner, for example, whose name is going to be disclosed on the audit opinion, needs to be CPA is necessary. So there's a decline in the number of people sitting for CPA exams. Not only that, is the pass rate of people who, the ones who are actually taking the exams, the pass rate is declining. Going now, thinking about what's going to occur into the future, we see that the number of students who are pursuing accounting degrees has been on a steady decline in the United States. And accounting programs are expecting a decline in future enrollment. So it's not that we're just experiencing a short-term problem. It seems to be a more pronounced and long-term problem. Within accounting firms, even the turnover rate of CPA firms has increased significantly. The IPA survey finds that, almost 1 in 3 professional staff people there will be turnover. So a significant rate, up to 29% now. 1 in 20 firms actually said that they saw their turnover rate shoot up above 30% over the last year. And so this is, an ongoing issue on many fronts, right? So turnover in the current population, low growth in the future population of the firms. And then in a survey of CFOs, they noted that from a preparation side, attracting and retaining top employees in finance and financial reporting is a problem. And as one of the leaders of one of the major CPA firms said, this is not a short-term issue. It is here to stay with us. So I think when we start talking about the talent problem, we should start looking at the composition of the firms and how the firms relate relative to the US population. So can I please advance to the next slide? So if we look at this, we'll see that accounting is experiencing a problem attracting talent, largely because the population is changing, but the accounting talent pool does not seem to change. And if it changes, it's changing more to become less representative as the US population is becoming increasingly more diverse. And so if you focus on the charts that I show you, you would see that in recruiting, the firms are doing, their best in terms of professional staff who are entering the profession. But as soon as we start winnowing down to the groups that are going to have responsibility and significant responsibility over audits and financial reporting, we see that the inclusion of underrepresented populations and diverse populations, it just starts to shrink. So the pool for CPAs, and then when we get to partnership level, things just become significantly worse. And if one even looks all the way to the right and look at the US population relative to composition of who is in a public accounting firm, who are working on audits, we see that we are not mapping in. So it's no surprise if we don't look like the population that we're having a talent crisis, or I would argue that's a key part of the talent crisis. So next slide, please. So when there are conversations that on the issue of the talent crisis, in my view, in my experience, these conversations never focus on the fact that the firms and the talent that is being used to conduct audits are not as diverse as the United States. If you do not have a diverse talent pool, and people that you're pulling into the profession, you're by definition limiting the amount of people that you can attract and retain. Not only that, research shows that for the young population and generation of people who are entering the audit field, that population really wants to work in a diverse environment, and they value working with colleagues who come from diverse backgrounds, and they want their employers to be interested in diversity. From a performance perspective also, it is key for firms, when I say firms, I'm talking about the audit firms, it is key for them to consider that more diverse teams all often have better performance results based on research that is done. Not only generally in business, but if we look at governance issues, there are papers done by Laura Field, who was one of my colleagues, and also Michelle Harding from Virginia Tech. Those papers show that when the board is more diverse, that there's greater accountability of the C-suite executives. And so if we kind of think of a parallel or reasoning by analogy, we would expect that greater diversity in the teams that conduct audits will probably lead to better performance. Particularly stark is if one looks at lack of inclusion of Black talents and Black professionals into the public accounting population. We have seen some growth if we look at the trends data over time. We have seen slight growth in some of the other minority groups, but we have seen the proportion of Black CPAs has remained unchanged since the inception of NAB. It was 1%. If one looks at there's a book written by Theresa Hammond, Black CPAs in a white collar profession, at the data from her report, looking in the 2000s, the number was 1%. So we're not seeing any changes. Despite the fact that we're not seeing changes, the firms have been claiming that they really care about inclusiveness. And they have put out from time to time, we've seen announcements about we're spending this money, we're investing, we're having initiatives. Oftentimes, the reason that's given for a lack of inclusion in the profession is that there's a pipeline problem. But in my view, I think it's a myth, because if we look at the entry level coming into the profession, we see significant more diversity in the entry level. What's happening is that the winnowing is disproportionate, right? And so let's have the next slide so I could talk about some of the issues there. So there's been some research done as to why, numbers are starting off small and then they're getting smaller as people progress into the career. So why is that occurring? Many Black CPAs interviewed who have left major firms have said that they have left because of a lack of mentoring, not being placed on the jobs where they need to gain necessary experience so that they can develop the skill set to move to the next task. Some CPAs and auditors have said that they have faced discrimination, not only from peers, but also from supervisors. There are many discussion points where people said when they advanced in their careers, they were told by their peers that they were affirmative action candidates. Some people reported hostility by clients. Yet some people talked about a lack of belonging within the firm. Examples were given where a firm would host an event at a quote unquote plantation, and members did not feel comfortable being in those environments. So there's several explanations for why CPAs leave the profession, but a lot of it is lack of inclusiveness and them not feeling welcome within the profession. Another issue is the current role model that firms use for promotion. Often firms look to pick people who are a lot like the current partnership ranks. And so they will say, well, which schools have given us our top partners? And then they go back to those schools. Now, we know from the data that's released on education that the top schools tend to be less inclusive. And so if you start with a model that looks at a particular population and say, this is the success and this is what the successful person looks like, and then you try to replicate the model, it's not going to be surprising that you're going to end up with a model that is a group that is less inclusive, than one would want to have, or that the firms profess that they would like to see. Even as we move towards some of the advancements in the profession, looking at environmental issues, looking at social governance, those very discussions have not even considered diversity as one of the important factors that they should consider. For example, the ESG frameworks look at societal factors, but they don't look at equity, they don't look at justice. If one looks at who is on the board and who is setting policies with respect to ESGs, then we don't see people who are representative and inclusive of the populations that are harmed. And if we look at the data for environmental and climate issues, those costs are going to be most borne by people from indigenous, African, Asian, Indian, Middle Eastern populations, right? Even within the United States, the negative effects of corporate pollution tends to be disproportionately aimed at people from poor communities and racial minorities. Yet, this does not, these populations and representatives from these populations are not included in the governance structure of the very organizations that are purporting to measure and to care about ESG issues. Next slide, please. And so I would like to call on the board. I think, the board is certainly the most diverse regulatory authority in the US at this point, probably worldwide. I don't have all the data on that. And I think you have unique experiences, unique talents that make you perfectly poised to deal with this challenge that we have today. Thank you. And you can take the slide down.
Thank you, Professor Joe. Are there any questions from members of the IAG or members of the board or staff members of the PCAOB?
I think Tony was in front of me and then Erica.
Thanks, Gina.
Yeah, thanks, Jennifer, for your presentation, and many of the data points that you mentioned certainly resonate with me throughout, my career as being an advocate and a proponent of just, providing opportunities for, people based upon their talent and their desires to get ahead. I had an opportunity to participate in a forum, a student freedom initiative that's led by Robert Smith, and he's brought in many others to include government agencies, corporate sector, you name it, to get around, this issue of offering opportunities to either based upon racial, gender, or socioeconomic challenges, getting people in the accounting ranks. And it's a challenge that I've seen, again, from the financial sector, from my time at CFTC. I can remember at 2011, I walked into a board meeting, and literally I was the only person of color in the room joining that staff in 2011 after Dodd-Frank. So, these issues certainly resonate with me. But what I wanted to add in terms of the accounting field, and that field actually, producing folks who one day will be auditors, and then we talk about the CPAs as you eloquently explained. But is it an issue of when people become aware of accounting as a career option? It's, some of the issues, dealt with when I was in the Air Force, trying to get more people in the cockpit as pilots. It's when people become aware of opportunities because of sometimes socioeconomic conditions that you don't have families, friends, associates that have done these things that can pull you along and say, hey, think about these as career options. And by the time you may get into, your senior year in high school or even freshman year in college, when you start thinking about these options, it may be a little bit late for many people, especially if they're coming from backgrounds that they just haven't been associated with. So I certainly get the CPA element in the sense that, people are not making decisions to become CPAs, or, maybe there's other factors there. But just in general, does the accounting demographics look different in terms of those who are choosing it as a major, but maybe not graduating to get a CPA?
Yeah, so I agree with you in saying that maybe the knowledge of accounting as a career is certainly not as accessible as many other careers. If we think of, popular in the media, what gets showcased, we don't often see accountants. Maybe the accountant movie is not the best showcase for accounting talent, but we don't see accountants there. But even when we bring people in, and so, there's some research done that even when people of color come into an accounting profession, there is a certain way that partners are expected to behave. There's certain cues that you have to learn early in your career. And it's that lack of mentoring, right? Not necessarily coming from a background that affords you the opportunities to be groomed to become somebody who is a partner. Research in partnership and how people become partners often finds that successful partners are usually sponsored and groomed early in their career. And it's the disproportionate, grooming of young, diverse talent that, is part of the problem. But again, as human beings, we all tend to be most comfortable with people with whom we have shared interests and commonalities. And so a partner might say, gee, somebody, who graduated from my alum, I'm excited about that person and I want to mentor and work with that person. But, if we're looking at the top 20 schools, in the US, well then, those schools are not necessarily exclusive. I think firms need to be more open about where they get talent. Just as an example, Quentin Booker, who is now retired from Jackson State University, is a very talented person who was on the board of the AICPA exam. He was an examiner, noted person who was a financial accounting specialist. Well, many firms do not go to that school to recruit, right? But they're being taught by somebody who is writing the CPA exams. Many of the major CPA firms now just have a top 20 school list, and it's not necessarily top 20 based on school performance or anything like that. They do a look backwards and they say, where do our partnership ranks come from? Okay, these schools are producing our partners, and so therefore these are the schools we're going to spend our recruiting effort. And so instead of becoming more diverse, they're becoming less diverse in terms of talent and likely perspective, because when you're groomed and taught in a particular way, then that carries with you throughout your career.
Thank you, Professor Joe. I appreciate that thoughtful commentary. Gina, before we go to you, let's hear from Chair Williams. She has her hand up as well.
Oh, I'm happy to go after Gina. I think she raised her hand before me. Go ahead, Gina.
Thank you. I'll just make a quick comment. I just first, Professor Joe, you're right on target in terms of that social capital transfer and the fact that it needs to happen earlier in life. But I actually just wanted to support your findings with another piece. One of the 60 or so studies that I read trying to understand how data was used was actually published in the Managerial Accounting Journal in June of 2019, and it was called Client and Audit Partner Ethnicity and the auditor-client alignment. And not surprisingly, what they found was that co-ethnicity was often associated with audit partner selection, and that co-ethnicity was associated with higher auditor-client alignment. The downside of that was that co-ethnicity was also statistically associated with a lowered propensity to issue a going concern opinion to a financially distressed client, and an increased occurrence of underreporting of fundraising and administrative expenses, and that ethnic diversity in the auditor-client relationship was associated with higher auditor quality. From our perspective, that is a key finding that we kind of need to understand and explore more, and it's one of those many data points that we have to sort of infer. But nonetheless, I think that I just wanted to kind of put that out there as another proof point that not only is it sort of the socially right thing to do, but it is also meaningfully important to our goal as the PCAOB to ensure audit quality.
Yeah, thank you, Gina, for sharing that. That was such detailed information, and hopeful that those who are in the position to make changes are listening and will attend to these issues.
Yeah, thank you, Gina. Chair Williams.
Thanks, Amy. Professor Joe, first, I just want to thank you for this really informative presentation. As I noted in my opening remarks, this is an area that the current board really does care very much about. And we are really looking at diversity from two perspectives. One, internally and what we can do there, and then two, externally and what we can do to increase the pipeline and increase diversity across the profession. And internally, we've had a number of initiatives. We are continuing to expand our intern program, where we do provide really competitive compensation for our interns so that those from different backgrounds could intern at the PCAOB. We've reinvigorated our affinity groups. We're creating a diversity council. We're hiring a diversity and inclusion manager, and that posting is up. And then externally, we of course have our PCAOB scholarship program. And over the last 5 years, a majority of those scholarships have gone to diverse applicants and applicants from lower socioeconomic households. But I'm really interested in what you and others on the call think that we could do, some additional thoughts on what the PCAOB can do to use our platform to help lead in this effort.
So I think one of the things organizations could do is to consider where it's getting its talent and how it assesses talent. So oftentimes we look for, a particular thing rather than a skill set. Okay. So regulators might say, well, we want top lawyers in this position, but it's possible that one could be an effective regulator without being an attorney, right? The current board is a great example of kind of, breaking the mold a bit about, and I think that's a great example because the board is already began an open dialogue and more open discussion that we have seen in the past. The board is a good example for people when they see the PCAOB in action. As an academic, I myself can tell you that the PCAOB has had many joint forums on academic research, and often I would attend these forums, and like Board Member Thompson said, I would be the only person in that room. I think just an example that more people are there will make more applicants interested in the position. The other thing I think the board could work on is when there are openings, rather than just posting openings, actually going out and seeking talent and inviting people to apply. Because research has found that for women and for minorities, if they see a list of 10 items that are necessary for a skill set, they will only put in an application if they've got about 80% of the skill set, right? Whereas, people from majority and group and males, they will say, I have 20%. I think I could give it a shot and I can see what happens. But, people from a minority group are not willing, and I would say hesitant because of persistent rejection throughout their careers. So going out and inviting people into the pool could be one way to attract people. The other benefit, I'm hopeful that normalizing who is a board member, who has skills, so that when people see who sits on the board and all of us in this audience who are very diverse, that they will start saying, these people can be board members, these people can be talented CPAs, these people can be partners. And when they see us in this role, it opens opportunities for others.
Thank you.
Yes, thank you, Professor Joe. We have a number of hands up still, and I'm just going to take them in the order in which I saw them. So we have Parveen, then Lynn, then Hal, then Sandy. And just as a word of caution, we have 7 minutes until we really do need to move on to our next topic. Not to cut this one short, we don't have to end it here. There's always a to be continued. But with that said, Parveen, please proceed with your question or comment.
Thank you, Amy. And I think I'm running into this same problem again of echoing. One point I'll make is that it is a broader issue attracting overall talent to the profession, and diversity and inclusion is a sub-part of that. And we are already facing a lot of problems regarding the broader issue. So we need to pay attention to that also in order to make sure that diversity and inclusion is also properly addressed. Second point is at the IAG meeting of October 27, 2016, Lynn Turner and I had prepared a report and presented to the PCAOB board at that time on the ACAP updates on the human capital. I would recommend taking a look at that also to get the ball moving, rolling on this topic.
Thanks, Parveen. That echo actually lends a bit of statue to your comments. So that was kind of fun. So anyway, Lynn, please go ahead.
Yeah, I had a copy of the ACAP committee report here with me. And the very first section responds to your questions, Erica, about actual steps. because this has been a problem in the profession for at least 3 decades. So the ACAP looked at it. ACAP made a number of recommendations. It was that subcommittee was spearheaded by the former president of the American Accountants Association and the CEO of the AICPA, Barry Melanson. So I would suggest taking a look at that. I'd be interested in knowing what Gina thought of those recommendations and what additional ones there should be. I personally think until you deal with this on a compensation basis, you're not going to have much success. There has to be some compensation in this. This is why, to a large degree, the profession is having trouble hiring new candidates, but there isn't an industry that isn't. Medical care, legal, certainly software and electrical engineering, architecture, they're all having trouble. But you can get so much more money coming out of school going into electrical or software engineering. It makes no sense to go into the accounting departments, given the diversity there in compensation. Also, the pyramid employee structure within the firms doesn't work. It was mentioned the high turnover, and it continues to drive higher. Low pay, a pyramid, up or out type scenario doesn't attract the best and the brightest, and it's a fact the accounting profession no longer attracts the best and the brightest. So rather than talk about it, we need to see some actual things done and have the PCAOB measuring them. One thing that Jennifer mentioned was the hiring from the top 20 schools. When I was in the leadership of my firm, we did that without a doubt, just as Jennifer described. And it was even worse. If in your office you hired outside the parameters of the percentage of your candidates that had to come from the top 20 schools, the partner distributions in that office were lowered, reduced, if you didn't hire from the top 20. So there was a financial incentive to go to the Harvards, the Northwesterns, the Stanfords, the BYUs in Texas, Illinois. And so that is something that I would urge you to look at as part of your inspection process and get on top of that, because Jennifer was spot on, certainly my experience. But I think looking at that and the recruiting, the last thing I'd add is you got to mentor these people. These people come in and they don't look like the way everyone else in the office looks. And Jennifer talked to that point. And we've got to make sure that the firms in these offices mentor these people and give them an opportunity to be successful. And if that's not the case, they aren't going to stay. So I think you got your work cut out for you, but I think there are some things to do. Take a look at that ACAP report. I'd be interested to know if there's other things that people think should be done. But that's a starting point, and certainly you'd have my support on that.
Great. Thank you, Lynn. So we have 2-minute warning. Hal, you're up next.
Jennifer, excuse me, Amy, I'll just try to be incremental here, pick up on a few comments. I teach at 2 state universities, so I have a chance to see the supply chain in a much earlier stage than what Jennifer largely talked about was from, inside the firm on. And I talk to students all the time about directionally, what do they want to do? Why do they want to do it? I think Lynn has some of the key thoughts here. I'll just give you a couple key things that haven't been discussed so far. One is the cost of adding that 5th year. It has become a hurdle. It's a significantly higher cost, and some people in the class I've got to go leave and teach tonight, money is a really big deal to all the students. The second is the clearing the introductory accounting. Most introductory courses in accounting are incredibly boring. They hate it and don't want to continue. They want to get out of it as quickly as possible. They've heard from their peers that the work is standardized, boring, tedious, And I think that's in large part the way we've structured audits. When I was in public accounting, it was fascinating. I loved getting out and talking to people. We don't let auditors go talk to the clients anymore, at least at an entry level. That's been at least what the students hear, and most good students avoid the accounting and auditing aspects of business. And then they've heard about the long hours, and to Len's point about compensation, I can get much more money in other places that are far more interesting. So until we address those early pipeline issues, I think we're going to continue to struggle. And from just looking out at all of my students, this is not something that's going to get solved in the next 10, 20 years. This is going to be a generational resolution, and we've got to start much earlier in the pipeline.
Great, thanks, Hal. So Sandy, I'm sorry to cut you short. Can you speak pretty quickly? Sorry, apologies.
I just wanted to say, I agree with everything that Jennifer said and Gina said. In 2018, we took the new data from Form AP and we classified everyone by gender, so we could identify what partners of the S&P 500 were women. It's a very small percentage. And I think that we're literally updating that right now, 4 years later. I should have it, but this is one thing. The PCAOB has an enormous amount of data about who's on audits and who's the audit partner on every public company in America. And they have, we wanted to actually match, I see Gina nodding, we wanted to match it up to who was the CFO, right? And who's the audit committee chair. We never got to that. But I think that there's data in what you guys have and that you can highlight those issues. It was a personal project for me because of the fact that this isn't just an issue for people of color, it's an issue for women. It was an issue for women of my era in the firms, and only 50% of the class starts out as women, and only 10% of partners on the S&P 500 end up being women. So there's adverse selection there. So you have data that can help highlight the issue.
Yeah, so
Thank you so
want
much.
to quickly make one comment in that pipeline is only part of the problem. I really think this message needs to get out because often those in leadership roles at the firm always accentuate the pipeline problem. They would like to sweep under the rug the retention problem. And if you look at the AICPA trends report data, you will see that at the recruiting point, they're recruiting 38% from diverse populations. When they get to partnership, they're only making 18% partner. So yes, everybody knows someone who joins the firm is funneled out, but you're having a disproportionate funneling. Happens for women as well, as Sandy said, right? So we need to have changes within the firms as to how they grow and retain talent.
Thank you, Professor Joe. Board Member Ho, you have the floor.
Thank you. This is a great discussion. I just have a question for Sandy because I found what she was doing very interesting. How did you derive the gender data? Because I don't believe that's on the Form AP.
It is not. We looked at people's names.
Okay.
We then looked them up on LinkedIn if we could find them. If we weren't sure, we categorized. We had a bucket of other. I mean, not that, I get there's sensitivities around that, but what we were trying to demonstrate, and this was 4 or 5 years ago when it first came out, is what does that look like? And we just used names and LinkedIn profiles.
Great. Thank you. That's
Yeah.
really interesting. I do have some good news just to confirm. Especially Sandy uses the data a lot. On the auditor search at the bottom, there is like a link. It's not very clear that says downloadable data set. That is actually, I confirmed that has all the Form AP data. So
it does, but it's actually, when you're looking individually, easier to just do the search. Anyway, we can talk about that separately.
Yeah.
Great. Thanks for all of that. And again, thank you to Professor Joe for that wonderful presentation and discussion. And Sandy, kudos to the CFA Institute on that bottom-up fundamental research. We would expect nothing less. So thank you for that addition. The next and final. The next and final topic on the agenda is of great interest to investors, so we don't at all mean to cut it short in any way. David Pitt-Watson will provide his perspective on climate and accounting. David, a member of the IAG, is a visiting fellow at Cambridge Judge Business School and former chair of the UN Environment Programme's Finance Initiative. He is co-founder of Hermes, now Federated Hermes, shareholder stewardship businesses, which became the largest of any investment manager in the world. And with that, I will turn it over to David. Thank you.
Amy, thank you very much. And thanks particularly to the PCAOB board. I don't need to show any slides, so if you want to take the slide away, that's fine. I thought I might just talk for 6 or 7 minutes, and hopefully that can be the start of a discussion on this topic. But I think before I start, I think I should define what I am and what I'm not going to talk about. I am going to talk about climate and accounting. And by the way, this is a field that I work in professionally, so I should declare that interest. I work for investors in the field. But look, I'm not going to talk about the various proposals for new rules that are being proposed, for example, from the SEC, from the European Union, with the ISSB, these new rules for corporate reporting. They're important. They're sometimes controversial, and there's an important debate that is going on about them in the USA and around the world. But I'm not going to talk about those. I want to talk about something different. I want to talk about how existing accounting rules, the rules on which we all agree, how those rules relate to climate risk and how these in turn affect financial statement audits. I'd like to suggest that on the best evidence that we have available at present, there is a gap between the rules and the guidance on one side and what it is that we're seeing taking place in practice. That gap is of considerable concern to investors because investors have been pretty explicit about both the qualitative and quantitative materiality for them of climate issues in the financial statements. And therefore, if there was one subject in which investors would want an improvement, I think audit would be right close to the top. Climate would be right close to the top. But do please take away the slide so that people can see each other. But let me start with just some basic observations. I think we can agree that companies may face climate risk, and for some of them, that will be material. It will be material financially. For example, a company that owns a long-lived asset, such as an oil refinery or a coal-fired power station, when it's drawing up its accounts, it'll need to consider the number of years over which to depreciate those assets. It'll need to think about the potential impairment of those assets. It might need to think about what asset retirement obligations would arise. And that, as I say, is material because investors take a profound interest in these matters, and it affects how they invest, how they carry out their stewardship obligations, engaging with companies and voting and so on. Now, the principles of accounting and audit and the guidance from standard setters, I think, confirms what I've just said. Climate risk, like any other risk, needs to be considered when you draw up the accounts, and that should then be audited. So, for example, the FASB has made clear that environmental risks aren't different to other risks. It says, this is a quote, the application of many current accounting standards requires an entity to consider changes in its business and operating environment when those changes have a material, direct or indirect effect on the financial statements and notes thereto. And it goes on to say, when an entity considers the effects of environmental matters on the financial statements, it's a facts and circumstances evaluation that, amongst other things, considers their significance. And the IASB has similarly opined, and the IAASB as well have noted that it should be audited. The IAASB in particular focusing on consistency between other statements that the company is making and what it is that's in the accounts. Now, I think that guidance is helpful. Now, you can argue that it's hardly necessary. We have principles-based accounting, and the guidance is merely pointing to the requirements that are already contained in the standards themselves. As the FASB has said, climate risk should be considered like any other risk. So why is this becoming a big issue for investors? It's because today, as I said, I think there's little evidence that companies, and by the way, particularly companies in the United States, are taking climate into account when they draw up their financial statements. And if there are material assumptions, that those assumptions are being shown. Now, I think the best evidence for this is a recent report from Carbon Tracker. It looked at 130 of the most climate exposed companies in the world. So not the Fortune, not the S&P 500, the most climate exposed companies in the world. And it looked for precisely that evidence. Had climate been taken into account, and were the assumptions shown, and had that been audited? It found that the accounts and the audit report of almost every US company that it looked at to be wanting. Indeed, as an aside, and there's an article about this in last week's Financial Times, for some of the audit of foreign private issuers who were also quoted in the United States, discussion of climate appeared in the international standard report, but was absent altogether from the same audit report on the same company under PCAOB requirements. Now, I can't really understand why, for the same company, something that is a material audit matter is not a critical audit matter in the United States. But I wonder whether it illustrates the degree to which the country, your country, which I think has the most intense audit regulation in the world, actually looks like it's falling behind on this particular issue. So other jurisdictions are better. And where they're better, they are revealing gaps in the consistency of the information that is given in the accounts and other parts of company reports. So, for example, of that sample of 130 companies, more than half of them had net zero plans or targets or commitments, but none of those appear to be reflected in the financial statements. And by the way, that's highly material. So Glencore, for example, it's a coal producer, miner, amongst other things, properly noted that the assumptions that it was using to calculate the value of its assets and its profitability were inconsistent with the net zero targets, which have been agreed by the governments of the world. And it was itself committing to net zero by 2050 with a supportive policy environment. However, it was good enough, and its auditor was good enough, to note that had sustainable assumptions been used, they estimate that almost the entire value of the company's coal operations, that's about $10 billion, would have been written off. So this is highly material and financially material. And there is an issue about whether US audited financial statements are meeting the appropriate accounting and audit standards. Of course, look, issuers and auditors must claim that they do. And I would suggest that having a conversation or an argument about legalities on this really is a last resort. I don't think that's probably the best way to address the problem. Rather, I wonder whether these suggestions might be constructive for the board. First, would it be possible for it to offer in an authoritative manner clarification that is likely to deliver the insight that should be expected, removing any residual uncertainty as to whether material climate risks might be considered? This is what the IAASB has done. And the improved audit reporting, I think, would be highly impactful for investors. I'm not quite sure what would be the best mechanism, but it might be, for example, a staff audit practice alert, just confirming existing audit requirements to encourage compliance and support audit inspections. As I say, that could help encourage widespread improvement in both audit performance and reporting. For example, the audit practice alert might helpfully address climate-related considerations of risk, reporting in critical audit matters, use of specialists, obligation for the auditor to read other information, a consistency across reporting, all of those, which is broadly what the IAASB paper does. Secondly, I wondered whether the PCAOB might address in climate in its audit inspection reports. For those companies where clearly climate is material, has the auditor considered climate risk as appropriate in doing the audit, in thinking about and challenging the financial risk, thinking about the financial risk, and in reporting that in critical audit matters. Increasing climate risk faced by companies, as well as the growing number of company commitments to curb emissions and take other steps to address climate risk, all point towards there being an increased risk for the audit of the financial statements, and a greater focus on this within audit inspection process and related inspection reports would encourage compliance with requirements. So look, I hope that input is useful, but realize this presentation has not been about the potentially controversial new rules on climate reporting. It's about existing accounting and auditing standards on which we agree. And these might be thought to cover climate risk as they cover any other risk, and that will be material for a certain proportion of companies. But for whatever reason, this is not apparent in financial reports, and particularly in the financial report of US companies. And I'd suggest that the problem might usefully be addressed by the PCAOB issuing clarification and more explicitly including climate as part of their inspections. Now, look, in expressing these views, I think I would be reflecting the views of many, many trillions of dollars of investors in the US and globally. And if at some stage the PCAOB and its staff wanted to follow up with them, I'd be more than happy to help with that process. But I'd also be happy to answer any questions either now or following this meeting. And for now, let me conclude and just thank you for your consideration.
Thank you, David, for this presentation. I see a couple of hands. So Nemat, you're next, and then Len and Mary. And we have 11 minutes to be exact. So.
Thank you, Saba, and thank you, Professor Watson. So understanding whether and why climate disclosures should be mandated is something I've spent some time thinking about. And there are a few different arguments offered for why climate risk disclosures should be mandated, some of which I understand and others are less clear to me. To your point, if the purpose of mandating climate risk disclosure is because climate is a material risk to the investors of the disclosing companies, then wouldn't companies have incentives to voluntarily disclose such information? And investors and boards, especially if there's trillions of dollars behind this initiative, if investors and boards, and they do have influence over what managers disclose. So that's the role of regulation is not clear if the reason for the mandate is firm specific cash flow risks. And reason why I also ask this is because at least in the US, private companies are not required to provide public disclosures for the most part. I mean, there are banks and there are certain exceptions. So then to the extent disclosure requirements become onerous on public companies, it can push firms to the private sector. So there is this unintended consequence that is something to be considered. So back to you. I'd like to hear your thoughts.
Yeah, look, and as I said, there's many new proposals that I'm not talking about those now. This is just simply existing financial, existing accounting and audit rules. And for some companies, a climate risk will be material, and you would expect therefore to be able to see the climate assumptions that were being used. It's not saying what those assumptions should be, it's just saying that you should know what they are, as with Glencore, for example.
Is there some friction that prevents, like, the trillions of dollars of capital that supports this disclosure from not getting management to actually disclose such information on a voluntary basis?
Yeah, no, so it's just not being done on a voluntary basis. And we can speculate why that might be, but it's not being done on a voluntary basis on the basis of the Carbon Tracker report of the most climate exposed companies in the world.
Saba's on mute, so why don't we go with Lynn next and then Mary.
As we discussed on Monday, David, I think there's probably some things that could be done. The PCAOB gives a heads up each year to audit committees and auditors about the things they're going to be looking at. And that would be helpful if the PCAOB intends to look at things like on useful lives of assets such as refineries or extractive mines, oil and gas companies, to see if it's consistent with what they're publicly saying. But I don't think the financial reporting rules in the US are as clear and consistent with rules in other countries. You mentioned the CAMs. Rio Tinto, probably the best example that we talked about on Monday, where if you look at the CAMs filed in Australia or in London, they're substantially better than the CAMs on Rio Tinto that was filed here with the US with the same auditor on all of them, KPMG. But there is a substantial difference there in rules that contribute to that difference. And I don't think the PCAOB would be within its authority all of a sudden to say, we're going to hold you to the international CAM when our CAM has a lower threshold. I've said for some time that CAM needs to be fixed, but here in the US, legally, I think the PCAOB would face some issues. Same thing with assumptions. I'm not sure that the rules of the FASB would require, and certainly in practice, it's not that they companies do make disclosures of some of the assumptions. You mentioned the net zero by 2050 that have been agreed to use your words, all the governments. So not all the governments have agreed to those. We all know India, China, Russia, and even our own Congress here in the US have not necessarily bought into the being to net zero in just under 30 years. And that presents some very fundamental issues for the members of this board unless they go through their full public rulemaking type process. And I think they have to do that, or they would face some substantial pushback and may have some issues up on the hill as well. But I do think it's something that they could look at in inspections and notify everyone in advance that, you know, we're going to look at your useful lives and see if they make sense with what you're telling audit committees and the public about how long these things go. Are they consistent with your business strategic plan? Certainly Dwayne's been in electric utility and he understands these issues as good or better than anyone else. But if you got an electric plant that's generating boku cash flows today and you don't have a plan to shut that plant down in the next 30 years, you're not all of a sudden going to take an impairment. There's a refinery, oil gas refinery here owned by Sunoco out of Canada here in Denver. And if that plant is making positive cash flows and looking good, it's going to be, under the existing rules, I think it's going to be very difficult for an auditor to turn around and require a write-off of that asset absent some evidence to the difference. Some of these probably
I think,
need
Lynn,
to be written off.
I think, Lynn, if I might, I'm completely agreeing with you on all of this. And of course, if an asset's based in Sweden or an asset's based in China, you would need to think about it. You would need to think about it considerably differently. Nor is anyone saying that anybody needs to write anything off. Just simply that the investor needs to know what material climate assumptions have been made, and that those material climate assumptions are available to them. And I think you're also right in saying this is not, it's not straightforward in terms of the way that you'd frame this, and we're not going to solve it in the however many 4 minutes we've got left, Amy, or however long.
Just two.
But there is, I think, if you read the Carbon Tracker report, there is a big gap, and there is a gap between what it is that the information that's available to investors in the States and the availability of information to investors elsewhere.
David, I appreciate that. Lynn, thanks for the question. I really want to give Mary some time, but I also want to clarify that, you know, we have these subcommittees, the broader subcommittees and subcommittees that we're forming. We're not done today. So we'll have a lot of time to dialogue, hopefully with the board, and have these engaging conversations ongoing. So Mary, please proceed.
Mary, you're on mute.
I can't hear you. No.
You're on mute.
It doesn't say she's on mute. Brian, is she maybe on mute administratively?
No, I think this is a case of perhaps having to pick a different microphone.
Okay. She's going to type it in the chat. That's helpful. All right. So with that, that's great, because then we can wrap up. So Saba, do you want to have some closing comments here?
Sure. Thank you, Amy. I just wanted to say thank you to everyone for your significant participation, contribution to today's discussion. It was, you know, my first one, and I mean, I think you guys did an amazing job of providing your perspective, and I hope the board finds it of use, and I'm sure they do. So just wanted to say thanks to everyone. We'll have we'll send out some dates in the near future for the next IAG meeting. There will be 3 meetings next year. We'll share details, as well as we'll share details on the subcommittee. So thank you, and back to you, Amy.
Yeah, thank you. There's a drill happening in my house, so I apologize if you can hear it. I want to stall a little so Mary has time to type quickly. But I just wanted to say thanks to everyone involved. I know it's been so many months since our last meeting, and I know that everyone's chomping at the bit to get to work. And to that end, we did send out some broad subcommittee topics that we've already discussed. We thought there was a lot of overlap, so we've collapsed them into 4 broad subcommittees and then subs under that. We are looking for volunteers for all of those committees and subcommittees, so please email Saba and me. We're going to be setting up likely an administrative meeting for the IAG to discuss procedures associated with writing comment letters and other administrative type topics on how we're going to operate as a group. And lastly, I just wanted to say as a past IAG member that the engagement amongst this group, as well as the collaboration with the board, was really heartening to at least me, I think others as well. So I really appreciate the attentive engagement by the board and the members of the IAG, and really do look forward to this ongoing collaborative dialogue, because I really think it will benefit the investment community. And with that, I think Mary got her question in here. Nope, she didn't. So we'll look for that on email at some point. I don't see it. Does anybody else see it? I don't. She's waving me off.
Yeah, Amy, she did put it in the chat. Oh, I'm sorry. She sent it to me. She said, climate change is a material financial risk. Is not generally part of the investment narrative. Very important.
Great. That is good feedback. And again, we can pick that up with that emerging issues subcommittee. So with that, I think we will close up the meeting. Is that right, Saba?
I think so, unless Chair Williams or the board members have any closing remarks that they would like to share.
I just want to thank everybody. I want to thank both Saba and Amy for hosting, and also for all of you. It's been tremendously helpful, and I've really appreciated the discussion and dialogue and look forward to it continuing. So thanks very much. Everyone have a good evening.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.